Hi, this is Stuart Weems, and thanks for listening to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights, and tips to help you master the game of building wealth. In this episode, I'd like to talk about 3 strategies to fund school fees. Now, that could be private school fees, obviously, it could be Catholic school fees, which tend to be a little bit lower than traditional private schools, or extracurricular costs if your child is going to a public school and you expect some costs associated with that. So it's really educational costs, if you like. And I read with interest over the weekend the average increase in Victorian private school fees last year was 3.6%, but I know the longer term trend in terms of increases is closer to 5%. Obviously, with wage inflation and CPI pretty low at the moment, obviously private schools have a bit of pressure there, so that's probably why it was a little bit lower than trend last year. So, there's 2 things to consider with respect to that. If you had a child today, for example, they're going to start primary school and then secondary school in the years to come. We've got to recognise 2 things. The first thing is that it's not going to cost what it's going to cost today. The cost will be a lot higher because school fees tend to increase at a higher rate than inflation. And secondly, we've got to pay those costs from after-tax dollars. So that's that's considerable. If a private school education, for example, in Year 7, so if I had a son that's starting Year 7 this year, and it was going to cost, say, $28,000, that if that's what the cost is today in today's dollars right now, if I had a son that's born this year and they're going to start school in probably 9 years' time or 10 years' time, whatever it is, 12 years' time, I should say, the actual cost in today's dollars of what it will cost at that time is closer to $40,000 or over $40,000. So really, we might sit here today and think, oh, look, it's $28,000, it's a lot of money. But really, in our future planning, we've got to realise that in the future, that's actually going to cost $40,000 because of the way these fees increase. And really, I need to be earning $70,000 pre-tax in order to meet that expense. So private school education, really any educational costs are expensive because they're paid from post-tax dollars, and the cost of education tends to increase a lot faster than CPI. So what I want to do is share with you 3 strategies you might consider implementing as soon as possible, even possibly before you even start a family, to ease that burden of that cash flow burden of significant education costs. Before I get to the strategies, my general advice is steer clear of educational funds. So ASG is a business. I think it stands for Australian Scholarship Group, which sounds like a benevolent organisation, but they are a business. Anyway, ASG is probably the biggest educational fund provider, and essentially what they do is they sell you a product where you need to contribute a certain amount each month. They will then go and invest those monies, and the projections suggest that that'll help you fund educational costs in the future. The only problem with, or the big problem with ASG is their returns are terrible, investment returns are terrible, and the fees are high. So it sounds like a good product on the face of it, but really when you pull it apart, it's pretty ordinary. And one of the 3 strategies that I'm about to talk about will probably be significantly better for you to do. So steer clear of educational funds. The first strategy is really just parking money in your home loan. And the reason I say home loan is obviously the interest rate you pay in respect to your home loan. And when I say home loan, it's a non-deductible loan to fund the purchase of your home, so non-deductible debt. And the reason why parking money in your home loan is good is because the interest rate that you pay in respect to your home loan, maybe it's around about 4% today, give or take, is always going to be a lot higher than deposit rates. And deposit rates are sort of circa 2.5% at best. So you've got at least probably 1.5% to 2% differential there in terms of interest rate, and you're much better off then to park that extra savings. So what I'm suggesting is, for example, if you had a child born today and they were going to start secondary school in 12 years' time, that if you put $1,200 per month of extra repayments into your home loan, and you did that really for the next 18 years, but in 12 years' time start redrawing the cost of school fees, so you park that extra savings in your home loan, and then in 12 years' time when your child starts secondary school, you take the money out, that's the best way to achieve that. So it would cost you sort of $1,200 a month, or really $258,000. The hard cost in the future I've worked out to be approximately $280,000. So if you did nothing, it costs you $280,000. Whereas if you parked in your home loan, it's going to cost you $258,000. So about a $22,000 savings there, and the $22,000 savings is really the interest that you've saved by making those extra repayments over that time. So that's a really conservative, low-risk way of kind of a bit of a forced savings, if you like, to use your home loan as a sort of savings account, future educational savings account. Okay, so the second strategy is to invest in the share market, and so that would work similarly to how the home loan strategy works, but you would take a certain amount each month and contribute that into the share market. Now, obviously the first thing that jumps to people's minds is, okay, yeah, but which shares do I pick? And depending on that decision will determine what your returns will be. Well, don't worry about it. You don't need to pick shares. In fact, Vanguard, which is a not-for-profit index fund provider, the largest and oldest index fund provider in the world, has a diversified index fund that's listed on the ASX, the Australian Stock Exchange. So you can just buy shares in this one stock, and it gives you a very diversified exposure to Australian markets, international markets, smaller companies, emerging markets, and also some bonds with just one trade. So you buy this one stock, and the fees are very low. They're about 0.27%. So really you're not going to get any lower than that for such a diversified exposure. And to do that, all you need to do is have an online share trading account. CommSec or CMC Markets tends to be the lowest cost. And then each month you would then buy shares in these Vanguard funds. And I've got the link in the show notes of the podcast to which Vanguard funds I would suggest. As examples only, of course, this is not a financial advice. And in the long run, returns in Australian and international equity markets have been, since 1980, have been sort of circa 10%. All right, so over the last nearly 40 years, it's delivered about sort of 10% returns. So I think you could probably realistically expect the same in the next 40 years. But being conservative, I've gone with 8%. So I've assumed that if you put in 8%, and I worked out, well, how much would you need to put in order to fund those educational costs, holding everything the same, using the same assumptions as I used in the home loan strategy. And instead of in the home loan strategy, we put $1,200 a month into the home loan. Well, the share strategy, you'd have to put $1,210 a month. So slightly more than the home loan strategy. But obviously I've used an 8% overall return, 4% income, 4% growth. If you're able to achieve, or if the market delivered a higher return than that, well, obviously you're not necessarily going to need to put that much money in. But they're interestingly, they're both very so similar in terms of the cash flow cost of the strategy. The third strategy would include going out and buying an investment property, and you'd buy that today. And then what you would do in 12 years' time, when your child started secondary school, you would borrow against the equity of that investment property. You'd obviously need to have the borrowing capacity to do that at that particular time. You borrow against the equity of that, and then you would gradually draw down that equity to pay for the school fees. So that is, you would borrow to pay for the school fees. At the end of school, so when your son finished, or daughter finished their schooling, so year 12, I worked out that your loan, including the compounding interest in respect to that loan, would be worth about $450,000. But you would have net equity after all selling costs, capital gains tax, repaying the original loan to purchase the property. You would have net cash equity of $900,000. So in fact, you would end up with $450,000 in your pocket after this strategy was implemented. And in terms of the cash flow cost, the cash flow cost of holding that property for the next 18 years is $210,000, which is less than the first strategies. The first strategies were about $250,000 to $260,000 of cash flow. The investment property is $210,000, and more importantly, you end up with $450,000 in your pocket at the end of the day. So certainly the investment property strategy is a better strategy. Of course, it's high risk though, because it's high risk because you're borrowing to invest, and whenever you borrow to invest, you magnify the returns, be that positive or negative. I've included the assumptions. I've been quite conservative with the capital growth assumptions in my numbers. I've only assumed 6% capital growth, which is really conservative. I would expect if you're investing in investment grade property, you would get more than that. I've assumed a 3% gross rental yield. I've assumed mortgage interest rates at 6%, so obviously a lot higher than what they are today. And I based that on a $750,000 investment purchase. Anyway, I have all this information in the show notes and the blog on our website. But I guess what this all shows, well, firstly, before I get to the summary, why does the property one work better? Well, it's not because property is better than all the other strategies, but there's three reasons properties come out well on top. The first one is, in my numbers, I've assumed the highest return for property. So really, in the home loan strategy, the return is, say, 5%, which is what I've assumed to be the long-term home loan interest rate. Again, just to be a bit conservative, it could be more than that over the next 18 years, but I've just been conservative. In the share strategy, I assumed 8%, so that's a lot higher than the home loan strategy, 8% return. And in the property strategy, I assumed 9%, being 6% growth, 3% income. So really, you could say, well, Stuart, that's a bit unfair because you've assumed a high return for property. Well, the only reason I've done that is the volatility rate in property is about half that of shares. So I've tried to accommodate that risk of volatility in the differential return rates of return. The second reason property works best is because it provides most of its return in capital growth rather than income, and that's more tax effective. And there's a separate podcast on that issue. And lastly, the property strategy works out better because we have borrowings, as I've suggested. So it's important to understand what's driving these results, because it's important to understand that I'm not saying that everyone should go and invest in property. I'm merely just saying, well, this is what a strategy would look like, and these are the potential outcomes. So naturally, if you have young children, you're certainly contemplating sending them to private schools, then naturally you need to start thinking about which strategy is going to be appropriate for you. And obviously that's going to be, and it could be one of the three strategies that I've talked about, or it could be something different. But it's going to depend on, the age of your children, how far away you are from those costs, your expected income, your current asset base, your risk profile, any future changes. There's what your existing investment strategy is. All these sorts of things come into play when formulating what a long-term strategy looks like. But I guess the key thing to remember is that, or the key purpose of this blog is, firstly, to understand there are strategies available, and secondly, the sooner you implement those strategies, the better off you are. If you're leaving it to the last minute or leaving it too late, it's going to put pressure on the strategy, in terms of working, and pressure on your cash flow. Also, these examples that I've used are really funding secondary school education costs. But if you plan to send your kids to primary and secondary school, and there's associated costs, so they're both private, well, it's even more important for you to develop a strategy. So there you go. The best time to start planning for children education costs was yesterday or 10 years ago, but the second best time is really today. So if this applies to you, then I would strongly encourage you to have a read of the blog on our website, and then reach out if you need any help. Okay, that's it for this week. Bye for now.